All right. Well, I think we're going to go ahead and get started. We are recording this, so we will certainly send the recording out to all the attendees, and we will also have some questions during the presentation, and we'll save some time for Q&A at the end. So if you have any questions, make sure to just raise your hand, and we can certainly get some participation going. But super excited. I'm David Chuddick with Parallel Financial, and we are hosting a series of webinars this fall just to put out some valuable information. The first one today is with Greg Towner. He's our firm's Chief Investment Officer. We'll have Gordon Short talking about some historical preservation trusts in the future. And then in October, we'll be speaking with Cam Knight on some behavioral and mindset issues. So we're doing the best we can to bring some great information to the world. So today I'd love to introduce Greg Towner. Greg is just literally one of the smartest people I know, and I don't say that lightly. But whenever I'm in the room with Greg, I'm always at the very best. I'm the second smartest person in the room. Greg's been in the portfolio management business for a good while, and today we're going to talk about investment processes and some behavioral aspects to managing portfolios. So, hey, Greg, how are you?
Hey, David. Thanks for having me. Appreciate it.
Absolutely. So, yeah, tell us a little about yourself and take it from here, man. You're in the driver's seat.
Okay, sounds good. Well, let me actually go ahead and share my screen here for those that are on the video. I think they'll get more out of it that way. All right. So as you can see here, we're calling this presentation How Investor Behavior Drives Parallel Financial's Investment Process. And you're going to find out here in the next handful of minutes why investor behavior is just so important to us at Parallel. So David started to talk a little bit about my bio. Let me just cover it here briefly. I have been with Parallel since late 2014. I've been in the industry since 1999. And I always point out that I have both my CFA, which is Chartered Financial Analyst, and CMT, Chartered Market Technician. And I do that not to pat myself on the back, but because it's very indicative of how we look at the investing world. In other words, we combine both fundamental analysis and technical analysis, and we'll get into some more of that. And then shameless plug here, I did author a book a few years back called The Investment Lessons of 2020, How an Unprecedented Year Taught Us Everything About Investing. And by the time we're done with this slideshow, you will probably not be surprised that that book is largely about investor behavior. So let's move forward with that. Well, let's start off with a quote. I love quotes. Some are directly from Investing World, some are not. The investor's chief problem, and even his worst enemy, is likely to be himself. This is from Benjamin Graham. And for those of you not familiar with Mr. Graham, he was a professor at Columbia University of Finance way back when. He was actually Warren Buffett's professor and first mentor, legendary investor himself, as well as author of very famous investing books. And so this quote right here really gets into the mindset of what we're going to be talking about today, as well as our process. So when you think about the investment philosophy for us at Parallel, we talk about how the long-term benefits of compounding can often be interrupted by investors making behavioral mistakes. So we strive to build our portfolios in a way that help reduce those emotional decisions that we've seen so often over time. We're not going to say we're going to completely eliminate it, but we're doing our best to try to reduce the likelihood of investors doing something that interrupts that compounding. And speaking of interrupting compounding, David, we love all these different studies that come out over time that look at how investors do compared to the funds that they're in. Different firms have done that. Well, just here in the last couple of weeks, the really well-regarded investment firm Morningstar did their annual survey, and they looked at all of the mutual funds and all of the ETFs over the last 10 years. And what they looked at was the total return of those funds, which was 8.2% per year. And then they looked at the actual returns achieved by investors in those funds, which was only 7% per year. So investors in those funds only achieved about 85% of the returns potential. And that included index funds. So it didn't matter if they were just in basic index funds, if they were in actively managed funds, sector funds, fixed income, what have you. It all averaged out to they only achieved about 85%. And they called this study Mind the Gap because there's always seems to be historically a big gap between what investors achieve and what the funds they were actually invested in really returned.
So, Greg, what would cause that? What are some of the behaviors that might cause me to get less than what my fund should have optimally provided to me?
Yeah, absolutely. I mean, it's certainly a lot of it has to do with overtrading. I think right now, legalized sports gambling is really the rage. And I think people are just kind of in this trading gambling mindset. So you're seeing more of it than ever, it feels like. But that, at the end of the day, the two things, a lot has changed in my 25, 26 years in the industry. A lot has changed. But the two things, David, that have not changed and probably will never change are fear and greed. And that's ultimately what drives this difference in return. So think about when the market is declining a bunch and people are getting scared and they're like, I can't handle this pain anymore, get me out, and they sell. Well, when enough investors do that, that's inevitably near a low, and now the market rallies back, and then they see stocks going higher, and they're like, oh man, I'm missing out on this, and they eventually get back in the greed side of it. So it's the trading in and out, and they're allowing their behavior to do this, create this gap, so they're not even achieving the returns of the funds they're in.
Yeah, it's counterintuitive. If I told you the gas station on, near your house was selling gas for 50 cents a gallon, you'd probably go out and fill up your gas tank and you'd buy it while it's on sale. But we kind of do the opposite with securities, don't we? Is we say, that security or the market is down, so I need to get out. But in reality, oftentimes that's the exact opposite of what we should be doing, at least for a long-term approach, correct?
Yeah, people always look at past returns and assume that's what's going to happen in the future. Whether they look at some hot fund that did well and they're like, oh, I'll go into that now. That's probably near the top of it. And conversely, they'll say, oh, look at these terrible returns in, I don't know, small caps. Just let's say, I'm not going to invest in those. Well, then they're probably ready due for a new turn at that point. So,
Sure, absolutely.
well, let's move on to our actual investment process so we could talk about how we implement all of this. We use the acronym QRLT, and you'll see what those stand for here. So let's start with the Q, and it's for quality. This is particularly relevant for our portfolios that we invest in individual stocks. Everything that we've looked at, a lot of different studies, also from our own experience, high quality securities tend to have lower volatility. So again, our process is trying to reduce behavioral mistakes. And to do that, you need to have some lower volatility instruments in your portfolio. Yes, if the market is ripping higher in some crazy bull market, we may trail a little bit. We're less concerned about that. What we want to do is during those difficult periods where investors might bail out, if we can have a portfolio that's a little bit less volatile, maybe they're less apt to interrupt that compounding as we showed before. And a lot of times the next question people ask is, well, what is quality? And that's a great question because there's a lot of different ways to measure it. We don't try to do it ourselves. We utilize two great third parties, Standard and Poor's, as well as Value Line. And they've been looking at it for years. And so we follow their exact measurements to know that we have to invest in quality. Doesn't mean that securities can't go down in price, of course. It just means they're less volatile than the really high beta type ones.
Sure. Now, devil's advocate, Greg, does investing in quality securities maybe eliminate some of those home runs, like some of that, hey, if you would have invested $10, you'd now have $20 million in a company? Are we maybe missing out on some home runs?
I would say pretty rarely. We
Okay.
are fortunate to have a lot of really strong performers in our portfolios that we've held for a long time. I mean, if you think about some of the big mega cap companies, I'm not going to name names here, but some of those big mega companies everybody's familiar with, they have incredible returns and they most definitely pass our quality metrics. You're just talking about companies with poor financial statements that when things are good, things might look okay for them. But when the economy gets bad and the stock market gets bad, really the reality of their financials hit and then they just really get crushed during that time.
Awesome. Thank you.
So on to the R, that stands for both rules-based and risk management, which go hand in hand. We feel strongly that you need to have a disciplined rules-based process to help reduce some of those emotional mistakes. A lot of times people are just like, oh, what did they see on TV or what did they see on social media or what did their friend tell them about? And okay, maybe that's fine for a small amount of play money, but not for your real money, not for your retirement money. You need to have an actual discipline and a process in place. And we're certainly not going to get into every little bit of our process here, but one broad stroke that we do follow is what we call the core and satellite approach. And what we do with this is we try to blend the best of buy and hold with some active management and risk management. And so in any one of our portfolios, whether it's one that invests mostly in ETFs or in individual stocks, we have a number of core type holdings, call it roughly three quarters of the account, are in these high quality blue chip type positions that we're going to hold for the long term. Occasionally we'll trim them, occasionally we'll add to them. Every once in a great while we'll sell them if we think we need to, but we like to hold those. And then we supplement that with these satellite type positions where we think there's better growth potential. Maybe there's a certain thematic potential that we see, but we know with that greater potential sometimes comes a little bit higher risk and higher volatility, which of course we're trying to eliminate or reduce. So that's where it ties in with our risk management strategy. Basically, what happens is when we purchase a security, we set a risk level. And if the security drops below that, if it's one of our core holdings, our buy and hold positions, we'll do a new full review of that position, make sure our original thesis is okay, and it's just a short-term blip. If it's one of our satellite positions and it hits that security or that risk level, we're just going to move on, assume that, hey, maybe we got this one wrong. Maybe we'll look at it again later, either go to cash or go to our next idea. There's no way you can avoid every little blip in the market. 5, 10, even the 20% ones are just that's the reality of investing. But what we're trying to reduce is twice in my career, we've seen market corrections, if you want to call them that, bear markets, let's call them, of 50% plus. Those are the types of things that are just not something that we want people to have to endure going forward.
Absolutely. And it would be really hard as an individual investor, and maybe not impossible, but it would be really hard to perform a new analysis when a security hits a certain level. I mean, number one, we're all busy, we have families, and number two, I've had clients say, "Well, my granddaddy owned that stock. He gave it to me. He wouldn't want me to sell it." Well, maybe your granddaddy wouldn't want you to hold the stock anymore because it's no longer a good holding. So to get that emotion out and use that rules based, I think is just crucially important.
Yeah, absolutely. And something else that we incorporate, and I mentioned it off the top, how we look at both fundamental and technical analysis. And this is very generalization, but you could kind of say we use the fundamentals as kind of deciding what type of security we want to purchase. And then we use the technical, or as you see here on the screen, trend and sentiment analysis to decide more when we want to enter, when we want to exit, that sort of thing. That's a little bit generalized, but it kind of gives you an idea of how we utilize those two.
Excellent.
So moving on to the L part of QRLT, this stands for liquid and low cost. The vast majority of the positions that we invest in have no commissions. Only a couple of mutual funds that are kind of in specialized areas do. We always try to, where possible, use low cost ETFs or individual stocks that
Just
don't have
real
trade
quickly,
commissions.
what is an ETF? Just in case anybody on the call doesn't know.
Yeah, the great invention about 30 so years ago, exchange traded fund. Basically, they're like a mutual fund, but much better. They trade intraday instead of at the end of the day. But most importantly, they're far, far more tax efficient than mutual funds. A mutual fund can, even if you don't sell it at the end of the year, can distribute capital gains to you and hit you with a big tax bill. Whereas an ETF, the way they're structured, they distribute little to no taxable gains.
Perfect.
And so we want, a liquid portfolio that you can get out of at any time and a low cost portfolio. Those are simple things, but they often are overlooked by investment managers.
Well, and compounding interest works both ways, right? So
Right.
the compounding effects of high feed securities can certainly be a drag on a portfolio over decades.
Absolutely. Absolutely. Well, speaking of something that can have a drag on compounding, we'll finish here with T, tax efficient. There's different ways that we think our portfolios are tax efficient. First of all, when a client first comes into us, sometimes they have these legacy positions that maybe they've owned elsewhere for years. We can work with them to decide how we transition out of those, or maybe we don't. We can hold them to the side if need be to try to do it in a more tax efficient manner. We definitely look for opportunities not only in the client's specific account, but across our portfolios broadly for what's called tax loss harvest opportunities. At any given time, there might be securities or parts of the market that are down, or maybe it's the whole market that's down. And we'll take advantage of that sometimes to sell something at a loss and invest it elsewhere. That way we have that loss to try to offset some other gains that we may be taking. And then I think a really unrecognized or maybe unappreciated way that we try to be more tax efficient is back to our technical analysis beliefs. We believe in holding your winners for the long term and selling your losers. So part of the risk management, you'll see us selling some stocks that maybe we haven't owned that long and they have a little bit of loss. So we're generating some loss there to use. And then we hold our winners longer term. The great retired portfolio manager Peter Lynch used to talk about how he wants to hold his flowers and cut out his weeds, right? And so that's the mindset here. So different ways where we try to be tax efficient in our portfolios. And before I get onto the next screen, I would say it's not so much part of our investment process, but since we're talking about ways that we try to reduce behavioral mistakes for investors, I would say partly what we're doing today and what we do in our regular monthly videos and our monthly papers, and when David and our other advisors meet with clients, we're having discussions around behavior and emotions, and we bring it up all the time. Maybe people get tired of it at times, but it's important for people to recognize that it's a normal thing for to have emotions around your financial situation. It's nothing to be ashamed of. And we bring it up all the time so people are aware of it so that they're not just hearing it when they're really feeling that stress, they're hearing it during all periods.
I can give you one of my least emotional clients. He called me in the beginning of April, and you know what was happening back then. And he said, and you could hear the fear in his voice. And he said, do we need to be doing something differently? Is this it? Like, is this the end? We talked through some things. We talked through some of your talking points of the graph goes up and down always. And I even told him that I had bought into the market a little bit that week. Yeah, now he's back to where he was plus some. And even the tariff situation in the beginning of April, that was a pretty steep dive. But, managing the emotion ended up saving him.
Yeah, that's great. That's great. Let's move on to our final slides here. We'll finish off with a quote. It's actually from myself. I pulled it from my book here because I think it's relevant for what we're talking about. Using a process that provides a smoother ride will help keep investors invested. Otherwise, it doesn't matter what the market does, they will not achieve those returns. And I think this ties directly back to that Morningstar chart that we showed earlier, where investors literally, on average, are not achieving the returns of, say, the market or what they're invested in. So people worry about, oh, am I beating the S&P? Am I beating the Dow? What have you? Well, the reality is, even if they were directly invested in those, more often than not, they're not even matching it because of the emotional side. So that's our goal. At the end of the day, you're not retiring healthily because you beat the S&P. You're doing it because you accumulated and saved and invested and didn't have emotional decisions around your finances, allowing you to get to your financial goals, not, oh, in Q3 of 2024, did I beat the market or what have you? Did you achieve your end goals? And that's why you hire David in our firm.
Absolutely. I would add that investment management, while it's incredibly important and maybe one of the most interesting parts of your financial plan, it's not more important than any other plan. So your insurance, your risk management, your estate planning. I have a client, her husband had passed away. He didn't list her as a beneficiary on his 401k. So that just created a tremendous issue. So the financial planning process involves tax planning. It involves a lot. Most of our behaviors will be the defining factor of where we end up financially. So, even are we spending too much money, things like that. Financial planning is an incredibly important tool, with investment management maybe being the most exciting portion of it, but certainly it's just a portion. It's not the entire process. Questions. We do have some people on the call. Does anybody have any questions about the investment markets, about choosing investments, behaviors, or anything like that? And then also, we'll give everybody just a second. If you would like to discuss this process and how it might work with your investments, I do offer a 10-minute vision call. So you can go to www.weeklywealthpodcast.com/vision, or just email me directly, and we can set up a time and talk a little bit about how some of this might work in your own personal life. And also make sure that you are checking out the Weekly Wealth Podcast on a weekly basis. So episodes come out every Friday. This week's episode that came out today talked about some things that I really wish that schools would teach our children, because financial literacy and actually financial behaviors are not taught. And then what happens is, you graduate high school, you graduate college, and you're in a hole starting out. Would love some insight on that and see if I left anything out. So, but we will open up the floor for questions. Or maybe Greg covered it all.
Well, I will have one other comment that I think, sometimes people find helpful and they follow the advice. A couple of things related. Number one, if you're feeling stress about the market, there's a couple of things. Number one, I would say, I always give this advice: never watch financial news television. They're there to entertain and scare you. So you will never find it.
Infotainment.
You will never find it on in my office. I shouldn't say that. I have one very close friend who occasionally is on. I will watch him, but usually only recorded so I can skip everything else. Look at your account less often. I even go so far as to tell people if they're really stressed, only look at it once a year when you meet with your advisor. And they just look at me like I'm completely insane. They're like, once a year? I look at it once an hour. But if you at least trend in the right direction, looking at it less, you'll feel less stress. And then the other thing I'll say is there's almost always something that can feel and look scary. You referenced this past April with the tariffs. There's almost always something, obviously the COVID period, you name it, there's always something that can scare someone about investing. But if you look at a really long-term chart of the investing history and you were to put all of those incidents on them over time, most of them people wouldn't even remember what that was about. Like, oh, the European credit crisis, what is that? You wouldn't even remember it, number one. And number two, it would just look like a little blip on the chart. So that's not to say that there aren't serious issues at times and the market can't have real problems at times. Of course it can. But the vast majority of times, it's just something that should generally be ignored by everybody except those in my seat, basically.
Absolutely. Archie has a question, but I just want to make a comment about that. One of the ways that you can help yourself emotionally as well, especially if you're in the retirement phase, is have a year's worth of cash in a money market. That way, if we have the tariff issue, take your money that you need for living expenses from cash and use give your investment accounts time to bounce back. So, okay. So Archie, if you unmute, you should be able to ask your question.
David, Greg, thank you. This was awesome. This is my first time on your podcast. And this may be a loaded question, and it may be a question that you can't answer here in the limited amount of time we have. But early in the call, you talked about not necessarily unloading or trading a position when it's down. And then later in the call, you talked about trading some positions when they're down. And I know that's a very fine balance for you guys in the way you manage a portfolio. Can you talk a little bit, touch on, how do you balance that? That's a double-edged sword.
That is,
It
and we're going to let
is.
Greg handle that one.
No, it's actually a great question, Archie. And I'll say how you go about it is following the rules-based approach. So when we decide to sell a position, the vast majority of the time, it's because we've set a price point beforehand. So it's already set ahead of time, as opposed to just reacting to what the market is doing and reacting based on fear. So I think what David was referring to earlier was if the market has some big, downturn, you don't want to be just kind of bailing out of everything because the market is down. I mean, those can kind of create opportunities at that point. When we're trading or selling out of something, we're almost always doing it because something has gone wrong that we've preset a level for, whether it's a specific price level or sometimes it's a fundamental change that we've evaluated. So again, we're not just trying to reduce the behavioral side of it for, the clients, we have to try to reduce it for us as well. We're all human as well. So having that kind of preset plan ahead of time to know what you're going to do if something happens, I would say is the way we go about that.
Thank you.
You're welcome.
And I think the overall answer might be like process based, and it's not an emotional thing, it's more of a process.
Right. And then we talk about it within our team. It's not just me. And we have an investment team that we would talk about, hey, this is what we're looking at. This is where we had this price level set. Is this still relevant? What's happening here? What are we going to do with the money if we sell? If it's one of our core positions and it triggers one of those risk levels, sometimes we'll actually be adding to the position. We'll take advantage of that downswing, saying, hey, this is one of our long-term core holdings. We actually want to add to the position here. So it's not an automatic sell in that case. In a lot of cases, we'll even take advantage of that downswing to add.
Hey, it's on sale, buy more of it. Sometimes if it's a good position, right? So
yeah, and I mean, at the end of the day, we always encourage investors to try to dollar cost average and contribute amounts, whether it be monthly or quarterly or what have you. That way, you're not having to worry about the timing of the market and you're just regularly investing. Some will be at high levels, some will be at low levels, but at the end of the day, you'll get a good average price as opposed to trying to decide, is this a good time to enter, a good time to get out, and so forth.
yeah. And there are times that you and I will talk, and I'm bringing on a new client, and we might say, hey, they have $500,000. Let's put 1/6 of it in the market, every month for 6 months. That way we're not having to worry about, are we getting in too early or too late? And we do it again with the process. So very thought out, and it's something that a lot of us maybe wouldn't do on our own. So awesome. Well, again, everybody, thanks for attending. www.weeklywealthpodcast.com/vision. If you'd like to set a 10-minute appointment and just check out the podcast, you can look out Weekly Wealth Podcast on Apple, on Spotify, on YouTube, or you can go to www.weeklywealthpodcast.com. Appreciate everybody stopping in. Greg, as always, just really good insight. To me, it's comforting to know that there's a method to the madness, how you're handling my money, honestly. And there's, it's not just being made on a whim. So that makes me comfortable personally.
Great. Thanks for having me on, David.
All right, everybody. Thank you.
Investment advice offered through Parallel Financial, an SEC registered investment advisor, able to conduct advisory business in states where it is registered or exempt or excluded from registration. Contents contained herein are for informational purposes only and should not be construed as an offer or solicitation for investment advice or for the purchase or sale of any security, insurance, or other investment product.